So this is the best beginner's option strategy, the wheel strategy explained.
Ton of videos on the covered call and the cash secure put, but I've never really answered the basic question of what is the wheel strategy? Like, why should I even watch those videos about the covered call and the cash secure put if I don't know what the wheel is? So in this video, I want to get down into the digital whiteboard. I'm going to give you a basic, picture of what the wheel strategy is and like why it's so hyped up and why so many people like myself are talking about how great it is. Then if you kind of like what this video told you, then you could go check out the playlist and look at a deeper dive inside the covered call and the cash secure put. So when somebody asks, hey Brad, why the wheel strategy? Why am I getting into it? This video will answer that question for you. Okay, so what the wheel strategy essentially is, it's using collateral to sell covered calls and cash secure puts to collect a buyer's premium, okay? So we have a couple of different vocab that we need to start with here. We have the collateral, that's pretty much a vocab word. Covered calls is going to be a vocab, cash secure put, and also premium. Once we get those established, we'll have a pretty good idea of what's going on. So first off, what is the collateral? So the collateral is going to be one of two things. It's either going to be 100 shares of a stock, and we call this 100 shares a contract. And the second is enough money to cover the cost of 100 shares. So if we're going to be using 100 shares, this is going to be called a covered call. If we're using cash, that's where we're going to be using a cash secure put. Now with a put, you might have heard of something called a naked put. We are not doing that. A naked put essentially is when you don't have the cash to cover the options trade that you're about to make.
No, a naked put is when you're selling puts outright. Just selling puts, doesn't matter how much cash you have in your account. It is still a naked put option. Now let's break down what a naked put option is real quick. So short put. So naked put sounds exciting, right? Right? Oh yeah, naked puts. Oh my God, let's go. But what they are at the end of the day is what is called a short put option. It is the opposite of buying a put. This is selling a put. Now remember, when you buy a put, hang on, short put versus long put. When you buy a put, it is, let's see, this is better. Okay. So when you buy a put, in fact, let me open this in a new tab so we can get it bigger. Okay, so we're only focusing on puts over here. When you buy a put, the price of the put goes up in value as the price of the stock goes down. Okay, so the put increases in value as the price of the stock goes down. This is a very bearish bet, right? The short put, which is exactly what he's talking about here, is when you are selling a put, which is a bullish bet. However, with a short put, you are limited in your total gains you can make, and you are unlimited in your total losses. Remember, what is the golden rule of leverage? Somebody type the golden rule in leverage in the chat. I'll show you what it is in a moment. Type in the chat, what is the golden rule of leverage? When you are selling a put, you're putting yourself in a situation where you break the golden rule of leverage. Now, it doesn't matter if you're calling it a cash secured put or you're calling it a short put. They are the same thing. They are exactly the same thing. That's like saying this blue jacket is the cash secured jacket. This blue jacket is a short put jacket. They are one and the same jacket. They are exactly one and the same jacket. Tony says, don't risk more than you can make. Exactly. Joe says, don't risk more than you can gain. Precisely. The golden rule of leverage is never put yourself in a situation where you can lose more than you can possibly make. Selling a short put, selling a put option puts you precisely exactly in that situation. So we're off to a bad start already, right? Now, this is not a criticism of him. This is me giving you feedback of this is why you don't do this strategy. So first off, you're putting yourself in a situation where you're breaking the golden rule of leverage. That's his number 2 point. Or, and like I say, don't confuse cash secured puts with a naked put being different. They are the same, the exact same. There is no difference. Okay. It is one side of this quarter is cash secured put. The other side of this quarter is a naked put. No difference whatsoever. Now, 100 shares of stock for a covered call. A covered call, guess what a covered call looks like? If you had to guess what a covered call looks like in its option in its risk profile, what would you guess that a covered call looks like? Right? Let's number these 1, 2, 3, 4, 5, 6. If you had to guess what a covered call looks like in its risk profile, 1, 2, 3, 4, 5, 6, the answer is number 6. It looks identical to the short put. It looks completely identical to the short put. Sorry, Manny. Sorry, Peter. Sorry, Vaclav. Unfortunately, a covered call looks exactly like a short put because you own the option, or I'm sorry, you own the stock, and then you're selling a call against it. So you still have unlimited risk because you still own the stock. It can still go down. But you have sold a call against it, so you have capped your gains. Yeah, Manny's like, wait a minute, I didn't know this. Yes, this is facts. A covered call and a short put have the exact same risk profile. David says, does that make covered call ETFs really stupid? I don't know. I mean, if it works for you and your trading plan, it could be amazing. But I'm trying to get perspective here of they have the exact same risk profile. Now, with the covered call, you don't just own the stock. You're selling the call against the stock you own. For every 100 shares, you can do one contract. And you actually collect premium, right? So let's say that you have a $100 stock and you are selling a call. You have been able to take in $2 in premium by selling the call. Effectively, you have reduced your cost basis from $100 when you bought the stock outright to $98. Okay, that makes sense, right? And so on the outset here, I can see how this makes sense to people. And it is also the same as if you sold a naked put outright. You basically are tying up capital with the short put or with the stock itself. You are moving your break-even point away from where it is today back by a certain amount. So in this case, let's say $100 is our original purchase price. We just sold enough to move that back. So we have now $2 in premium, essentially at the same risk profile as the short put. So let's continue on here.
And in both these cases, guys, we are going to be selling options, not buying options. And
remember, selling options breaks the golden rule of leverage. Right. The golden rule of leverage. Remember, if you're setting yourself up in a situation where you can possibly lose more than you can gain, you are selling options. You can't do that when you buy options. You have limited losses, period, no matter what. But if you sell any option, you are now going into this category here.
Guys, sometimes you'll see selling as writing. So for example, if I say I wrote a covered call, that's the same as me saying that I sold a covered call. And I'm going to dive into Robinhood and show you exactly where you see all these things and exactly how you'd move forward in making these different options trades. Now, the premium, guys, it's just going to be cash that goes directly into your buying power. You get it as soon as that option is fulfilled, because you can write an option and it doesn't get fulfilled. Just like you can put in a limit order to buy a stock and it not get fulfilled. Options need to be filled by the market, just like anything. And once they get fulfilled, that buyer pays you that premium immediately.
Okay, now this is a misconception, and this wanted to check the date of this was 4 years ago. This is exactly how, I don't know if you guys remember, but there was a story of a gentleman who offed himself because he didn't realize how much leverage that he put himself into, because in Robinhood at that time, that's why I checked it out, specifically in Robinhood, this was what they called, what did they say? Unlimited money glitch, basically. Selling options, then taking the premium that was put into your account and then going and buying more options with that. So dude had leverage to the tits. There was nothing left. He just did this over and over and over because in his mind, I sold the option, so I have my money today. And then I go out and I buy more options with it. And he had levered himself up so deep and so hard and heavy that he actually basically bankrupted his entire future because he thought that this was an unlimited money glitch. Now, on top of that, it shouldn't go into your account. The brokers that I've had have not let this happen, where let's say you sold the $2 put. Now you can go trade with that $2. That money's not yours until the trade is closed. That money is not yours until the trade is closed, is how I've ever had to deal with it. So if you are put in a situation where you sell an option and you have the money in your account immediately, I feel like that broker is asking for a hell of a lot of trouble, and Robinhood got into that hell of a lot of trouble because they let people go and buy it immediately with that money that they got in.
So I underline this upon fulfillment because oftentimes people say like it's not reflecting my portfolio value, for example. So like if you have $1,000 and on Robinhood you're watching your, your stocks do this and your, the amount in your portfolio go like that. Well, if you sold an option and got a $30 premium, it's not going to say 1,030. The 30 is going to go into your buying power, and then after expiration, that we'll talk about when I show you the
Never go into your buying power. It should not be available to you until the trade is closed. So surely that's changed since this was recorded.
actual options chain, that's when it will reflect your portfolio value. But you do have that money immediately. So if you have an expiration of say 2 weeks from now and you make that option right now, you get that premium right now. You don't have
This is fat. This is false. 100% verifiably false. I don't think he's doing this maliciously, but his data has changed.
to wait the 2 weeks to get it. So essentially, guys, the long and the short is we have some sort of collateral. We have 100 shares of a stock, or we have enough money to buy 100 shares, and we're going to use that as collateral to just collect premiums over and over again. Now,
Because and it has to have changed, Joe Six. It has to have. Because in theory, if you get the money back in your account right now, there are no guardrails for you to go spend that. And that's exactly what happened at Robinhood. By all means, please go look it up. If you get the money now, that then allows you to go buy things now. People have done this and they have effed up their entire lives because they didn't understand what they were doing. And then guess what? They're going to lose on the first trade. So that money that they took in immediately is gone. The money that they lost on the leveraged trade that they took is also gone. It is fact. This is not a possibility at this point. If there is a broker that allows you to do this, I think they're breaking FINRA rules. Could I be wrong? Absolutely. I could be wrong.
is worth mentioning, and I'll do a video on like the pros and the cons of this later. I have that coming up next week. But this is
But it's not adding to your buying power. I see what you're saying. It's not adding to your buying power. If you had $10,000 in buying power and you sold these options, you don't have now $10,200 of buying power. There's no possible way. No possible way.
taxed as ordinary income. People always want to know about the taxes, and like I said, it's taxed as ordinary income. Whatever your federal income tax rate and your bracket is, whatever that is, that's what you get taxed on your premiums. So now let's take a look at both of these covered calls and the cash secure puts and what you'd see inside Robinhood, and very similarly.
Okay, very cool. Yeah, there's no possible way that it adds to your buying power. Not possible. So thanks, Joe. Appreciate it. By the way, Copulus says he paid for one-on-one coaching on the wheel strategy. By the way, you're going to get this 100% free. 100% free.
Whatever brokerage you're using, and we'll look at all of these different pieces of vocabulary and we'll see where we're actually going to get paid and how you determine your premiums. So here, guys, is going to be what we call an options chain. It's all the different options inside the option, if you will. And I've used AT&T, one of my favorite stocks, to do the wheel with. My next video is actually going to be about all the stocks I do the wheel with. So if you're interested about that, subscribe or whatever, hit the bell notification so you know. But AT&T up here, we can see AT&T, and we have its current share price. Now, what you'll notice is I have to put everything on a sell. Remember, guys, we are a seller. We are not a buyer. All right. So when we say we are going to sell this, we have a share price. Now, this share price is also listed right here. So that's what the stock is actually trading at. And we call this at the money. Now, you can see I've done a put here. So what that means is whatever option I choose, we're going to talk about, I'm going to be using cash as collateral. Where now on this side, this is going to be the call side. So that means I have 100 shares of AT&T, and I am going to use 100 shares as my collateral. Right here, we see the expiration, and that's how long this option is going to stay open, okay? And if you want to know more about like the expiration date and the buyer signing, like I said, look at those deeper videos, but I just kind of want to give you this information here. The buyer has the option to assign or close this at any time in which the contract has been met. All of the things inside the contract have been met that we'll talk about, they can assign that at any time. Now, as a seller, we are able to close this options, but that's what you see inside that playlist. I did a video on just closing options. So now let's look down here at a couple of different other numbers that we'll see. The strike price, okay? Now, the great thing about the wheel is that we get to pick the price at which we would sell 100 shares or the price at which we would buy 100 shares.
Okay, so before you get super stoked into what he's saying right now, what he's about to tell you is since he's using AT&T, let's use AT&T. I don't know what was the price of AT&T back then. 20. Oh, that's funny. 27. No way. The AT&T price was $27.04 when this was recorded, exactly November 2nd of 2020. Guess what AT&T's price is this very day in 2025? $27.02. Pre-market says 27.04. That is unbelievably awesome. That is, dear Lord God, Jesus looking down upon us and says, Chris, if you want the very best example of all time, don't worry. I got you. I got your back. How funny is that? It's exactly to the penny, the exact same price as it was 5 years ago. Okay, this is going to get awesome. Okay, so looking at this, imagine for a moment, you're like, you feel like you are a genius, and you're like, oh, you know what? I love AT&T stock so much. I want to buy it when it comes down to $25. I want to buy it when it comes down to $25, right? When it comes down to here, Chris is like, yeah, freaking yeah, let's buy all the AT&T stock that we possibly can. All the AT&T stock that we possibly can buy right now. Okay? But we got a major problem. Can anybody point to the major problem with that theory? Anybody in the chat point to the problem of, hey, I would love to buy the stock when it comes down to $25. Go ahead. In the chat, let me know why this is a major problem right off the bat. The answer is because A, like Nate says, it could keep going down. B, it's already trending down. And if it goes down this far, hang on, remove this real quick. I want to do it this. If it goes down from 27.04 down to $25, you are already down 7.5% on your stock, right? Olivia says it's not 25, not yet. That's what I'm saying, is if it gets to 25, that's where the wheel strategy says, oh, I would love to own it at that price. It can go way further down. It's in a bearish trend. It's lying in a downtrend. Yeah, you don't know how far it's going to go. You don't know when it's the dip and when it starts to come back up. Sylvia says, I love the conviction. She has the conviction, right? If you love it at 27, you're really going to love it at 11. Exactly. If you are selling puts against it with the theory of, remember, short put, right? It can be at any price above, but when it comes down to here, this would, that bend right there would be the strike price. So the $25 strike price. If it comes down to this point, you know what? I'll take AT&T. And I've heard this time and time again, and it does not compute in Chris's itty bitty baby brain. If you want to own a stock for less than the current price, selling puts against it with the hope of, you know what? Maybe one day it'll come down to my price and I'll buy it. You basically are saying, I want this stock to come crashing down on me. Then I'll buy it as it's crashing down. I will be buying it as this starts crashing down, because at that point it should start going up, right? It should start going up. It's got a downward trend, 10 under 20, price under the 50. Exactly. That is the outlier trend template, 10 over 20, 10 under 20, price under 50. And you want to own it when it goes down another 7.5%. And you're probably thinking, well, Chris, of course, who wouldn't want to own a stock that's down 7.5%? There's a difference between an asset and a consumable, right? This coffee mug is a consumable. This jacket is a consumable. This hat is a consumable. Of course, I want to buy consumables as they're down in price, right? Of course I do. But on an asset, you want it to be increasing in value. Your home. Do you want your home to be going down in value? No. Do you want your stocks to be going down in value? No. So why would you ever look at this situation and say, I would love for this to go down 7.5%, and that's at the point I'll buy it? No. That means the stock is actually beat up hard. Nobody else wants to buy it. And you want to be the hero who says, I'll buy it at 25 as it's crashing down and we don't know how far it's going to go. Buying an anchor. Exactly, Hank. It's buying an anchor. All right, let's continue on. I don't know if you can tell. A, I know my shit. B, I'm super passionate about options trading.
So for example, right now AT&T is at $27.04. Let's say my basis on them is $28. And I'd be happy to buy another 100 shares of that at $26.
Bull frickin' shit. If I bought a stock at $28 and it's gone down to $26, let's just do the math behind it. Let's do the math behind it here. All right. If I bought the stock at $28 and it's gone down to $26, I'm down basically 7% on the stock. There is no possible way on God's green earth that I would be looking to buy more. Never going to happen. Any fool who decides that they're going to buy a stock when it's down 7% is a fool who soon shall be parted from his money. Do not, under any circumstance, do this. Precisely. Losers average losers. That's exactly what this guy's doing. Exactly what this guy's doing. Thank you, David. That's exactly what the wheel wants you to do. Your cost basis is 28. Oh, that's fine. I'm just going to average down and make my loss even worse.
So what I'm going to do is I'm going to write something called a cash secure put. And this strike price here is the price at which I would buy 100 shares. So the strike price is the...
Exactly. At this point, you have already become the bag holder. No, I can't say that anymore.
First piece of the options contract. It says, if the share price were to fall below $26, I will buy 100 shares for that $26, regardless of how low the share price goes. There's kind of like the give and take there. If it dives all the way to zero, you still have to buy them for $26 a share, which is one of the cons. Now with AT&T, the likelihood of going to zero in 1 week, very unlikely, but it could happen. Now the buyer wants it to go to zero, right? They want to get $2,600.
The buyer of the put option wants it to go to zero. Yes, we can agree with that.
For a stock that is worth zero. So for that likelihood and for that possibility of such a high return, they are going to pay you a premium to make that option and to fix in the price at which you buy it. That premium is showed over here at 14 cents. Now remember,
oh my gosh, 14 cents. Wow. Look at all the money you're going to make, right? Who wrote this, right? Somebody talked about collecting pennies as it goes down, right? You're down $2 a share. You're down $2 a share, and you think you're a genius because you just took in 14 cents a share. Oh, look at me making all these big old bucks with that 14 cents that I just sold, even though I'm down $2.
Contract is 100 shares. So this right here is really $14.
Look, I really appreciate being lumped into this. That really warms my heart that we should focus on successful trading strategies like David Ryan, Intervening, and Yule, etc. However, the issue is that this is prevalent all across social media space, but how great the wheel is. I'm telling you right now, the wheel is possibly the worst scenario you can possibly put yourself into because you're throwing good money after bad over and over and over and over. You basically have dug a hole and you're letting the wheel run you over inside of that hole.
In premium that you will get immediately upon fulfillment. These percent change, guys, and these changes, to be honest, I very rarely look at them when I'm just a beginner. That's something you look into further on down the line. Also, chance of profit. There are numbers called the Greeks, which kind of figure out this percentage, that the likelihood that this might happen. Once again, that's really just speculation. It's not set in stone. And this break-even price that you're going to see down here in this column, essentially, for you to break even, the price has to be at $25.86, because if you get assigned to buy 100 shares at $26, well, you also received $14 as well. So this is that $26 minus the...
Right. This is the price, the strike price. The break-even price here is taking the strike price minus the incredibly huge amount of premium that you got here of 14 cents. That is your break-even point.
14 cents per share. So now in this cash secure put, what do we want to happen? Well,
Kenny, thank you very much for sharing this. Everybody in the chat, put Kenny, Kenny. And the reason that I want to pay respects to Kenny right now is, you know what, dude? It sucks to take a loss. It sucks a lot. But to put yourself out, make yourself vulnerable on the internet sucks even harder. Listen, I would know. I'm all over the internet these days. But I want you to know I really appreciate you, Kenny, for having shared this experience, right? He's been holding Sound for 7 months. Let's go over to Sound real quick. SOUN. He's been holding Sound. Ooh, yikes. For 7 months. So if we're going to go back from July to January, all right, let me remove any drawings I have on here real quick. Remove 2 drawings. So if we go back from July to January, right, it looks like, give or take, Kenny, and I'm only making assumptions here, my friend. I really appreciate you sharing this experience. He's been holding Sound for 7 months, running covered calls, exactly what they're talking about here, covered calls / cash secured puts, making pennies, trying to bring my cost basis down, right? So around this point, Sound was around $24 or so, and now Sound is down at $11.42. So if we use the AT&T option strikes, for example, right? Kenny's probably trying to collect that 14 cents every week. How many weeks is it going to take for Kenny to get back to that point where he's made enough money on those 14 cents week after week after week to get down from $24 a share down to $11 per share? It's going to be huge. It's going to take a huge, huge, huge long time. So Kenny, you are awesome for sharing that because it helps illustrate our point. And I think you're a rock star for doing that, my friend. I think you are a rock star. But let's continue on here. Yeah, I remember there were a few channels pumping Sound at this point, for sure.
What we want to happen is we want the share price to stay up here in this.
Oh, wait a minute. I've been bag holding Vuzi for like 2 years, selling covered calls on it. And guess who got me to that point? This dude. How about that? How about that? The first thing that you will learn when you trade with Outlier is we cut our losers short and we let our winners run out of control, right? Cut your losses short, let your winners run out of control. There's no shame in taking a losing trade. Not at all. Not in the least, right? It's just part of the game. But to hold, in fact, I have this exact slide right here. I was about to quote the slide. Let me just show the slide. So Mark Minervini is one of my mentors. I work directly with him. He's one of the greatest traders of all time. He says exactly, there is no shame in losing money on a stock trade, right? Everybody does it, even one of the greatest traders ever. But to hold on to a loss and let it get bigger and bigger and bigger, or even worse, to buy more, average down, is amateurish and self-destructive, right? Taking the wheel strategy already puts you in a self-destructive loop. Starting the wheel strategy starts you off in a self-destructive loop, and you just follow into the loop and you get, you're imagine you're a nail in a tire, right? And that wheel is just rolling you over and over and over and over and over, beating you further and further and further down. That is the wheel strategy. I don't understand why anybody would want to do this.
This region here, because if it expires worthless at the end of expiration, if the share price has not dipped below $26, we keep this premium. And
dude, if it doesn't get below $26, you're entirely right. You get to keep all of that 14 cents. Goodness, I can't imagine what I would do with 14 cents. Oh man, rolling in it.
We keep our cash. In this case, the cash would be $2,600 would be the collateral or the cash needed to cover this put.
This is just your margin. This is just your margin. So let's actually use real numbers here, right? Let's say that in his case, he put up $2,600 in margin, okay? And he made 14 cents on that, right? So he made entirely $14. Woo, rolling in it. And then his cost basis here was $2,600. So the amount he earned compared to the amount of capital he had to put up, what was his return on capital? Any guesses? Any guesses what the return on capital was? It isn't going to be very much. Let's see. And then let's multiply that by 100 so we can get percentage terms. He made a whopping 0.53% return on this trade. 0.5% return on this trade. Dang. Oh my gosh. Could you imagine what your life would be if you could make a trade and make 0.5%? Yeah, bro, let's go. Let's go to the club. We got a lot of clubbing to do. Oh yeah, that doesn't even include fees, right? Woo, 0.5%. I'm rolling in it. That is not how trading is done. Not how trading is done. And if you're like, well, that's fine. I'm just going to win 100 times in a row. Okay, sure. So let's multiply that by 100, right? You have now made 53%. If you cannot lose in the next 100 trades, you'll have made 53%. Good luck with that. Good luck with that. And yeah, that's over 2 years, right? Hey, you know what? That's 26% for the year. You're totally right. If you don't F it up in the meantime, but everybody's going to F it up in the meantime. Nobody's going to be perfect over and over and over.
Now, if any time between now and expiration, the share price falls below $26, that's when the buyer now has the opportunity to assign this option and force you to buy 100 shares at $26. Now, if it dips below 26 and he doesn't assign you and then it goes back above 26, you're good. It's only while the share price is below that. So essentially, as somebody that's selling a cash secure put, we want the price of that option to stay high so that we can just collect the premiums and we don't have to necessarily buy the 100 shares. Some people want to buy the 100 shares, so they'll make this option closer to the share price. As you get closer and closer to the share price, the money goes up and up and up. The premium.
So far, he's only talked about half of the wheel. So far, he's only talked about the selling the puts against it. Surely he's going to talk about the other half of the wheel.
Increase the closer to the share price that you get. Now, people ask me all the time, like, Brad, why wouldn't I just get $199 and make this cash secure put here? Well, essentially, then you are buying 100 shares at $29 when it's only worth $27. That's a $200 difference, and you only got $199. So essentially, you'd lose on this trade right here. So
when he said you lose, that reminds me of the Willy Wonka thing. Good day, sir. You lose. It's exactly what that reminds me of. Buying the wheel is looking like hang on. Wait. Let's go onto YouTube. Willy Wonka, you
at a couple of different other numbers that we'll see. The strike price, okay?
Stop. Don't play that over there. There you go. This is exactly what it's like. 9 seconds. Yeah.
It's all there, black and white, clear as crystal. You get nothing. You lose. Good day, sir.
Do the wheel strategy, and this will be you. Let's play it one more time just for comedic effect.
It's all there, black and white, clear as crystal. You get nothing. You lose. Good day, sir.
Yeah. That is what it's like if you decide to start trading the wheel.
We never are going to make a cash secure put above the share price. It doesn't really make that much sense. If it's really close here, sometimes I've done it right at the money, like right above. If I think it's going to shoot up in the next day or two, it's very unlikely for the buyer to assign early or far away from expiration. As you get closer, that likelihood goes up. So if it's far to expiration, I might make something just above the share price if I think it's going to go up, but very, very rarely. Now, essentially on the covered call side, like I said, we have 100 shares. In this option, we are going to pick a price that we'd be happy selling 100 shares, and that would not be a big deal. For example, let's say we had AT&T at a cost basis of $25, and we'd be very, very happy selling it at $28. That would be a $300 capital gain, which would fall under short-term, long-term capital gains. It really depends on you. That's something I'll talk about in that pros and cons video. So you might make a covered call up here saying, if the share price comes up to 28, I'll sell off 100 shares. I'll take my $300.
I think he's doing a bad job of explaining this. Let me try to do a better job. I'm not saying that it's going to be a perfect explanation, but I'll try my very best. Imagine that you own the stock at $28. Okay, you decided you're going to buy the stock at $28. And you're going to sell an out of the money call. Let's use a different color for this one. We'll use blue. Let's say you're selling an out of the money call. Okay. During this time, right, you went from owning the stock, now selling a call against it. So your risk profile went from this to this. Okay. Why did it go to this? Your risk profile from owning the stock and then selling a call against it changed it from looking like this to this. Because you have now sold an option against it, a bearish option, mind you. You've taken your bullish position and sold a bearish option against it. By doing so, you are now limiting how much the stock can go up, which is why it looks like this. Your bearish trade is working against your bullish trade, right? This is a dumb idea, okay? So you can start by buying the stock and selling calls against it. You can start there. Or you could just sell puts. You could start there. Either way, you're starting from the same risk profile. If the price of the stock goes up, your shares are going to get called away, right? You actually do make the money between here and here, which is great. and you get to keep the premium that you sold, right? So in this case, maybe it was 14 cents. I don't remember, but that is actually the best case scenario for you. Is you buy the stock, it goes up to here, you keep the difference between here and here, and you keep the premium, and then it goes away. The wheel is over. The wheel is over. Okay. But let's say rather than buying the stock, selling covered calls against it, and it gets up here and then it gets called away, let's say you didn't ever own the stock. You just sold the puts that were down here. Now, as the price decreases, you're like, that's fine. I will love to take the price of the stock at $26 rather than 28. Okay. Remember, the starting price is 28. We didn't buy any shares here. We only sold the 26 puts. If it comes down to 26, we're now assigned the shares. So now we're already losing a buttload, right? We're already losing whatever the price of the option difference is from here to here. So it's at least $2 a share. We've already lost. And then if it continues down, now we have a leveraged investment working against us as it continues to go down. But don't worry. Don't worry. Now we sell calls against it, right? So here's where things get ultra effed up, right? You ready? You ready for this? Remember, I'm trying my best to explain this here. I know this is somewhat difficult. This is a decently difficult concept to understand, which is probably why people think it's great, because it's complicated. If you own the shares and it goes up to here, the shares go away. They're no longer in your account. You got to keep the amount of the premium you sold this for, plus the capital appreciation from here to here, right? So if we sold the 30 strike, you got to keep the $2 in capital appreciation on the stock as it went from $28 to 30 plus the 14 cents. So your total net outlay, or I'm sorry, your total net profit in the trade is $2.14. Everybody got that? Cool. But if we never had the stock to begin with and we started selling puts against it, we're going to be collecting that 14 cents week after week after week, sure, until it goes underneath our share price. Now, if it goes underneath our share price, we're already down the $2 to go from here to here, right? We're already down money, maybe not $2, but give or take. We're already down money. We're already losing money on the trade. And then you get assigned the shares. So now you own the shares at $26. That sucks. You never wanted these shares to begin with. Remember, you were selling puts. It was going down. You never wanted the shares to begin with. And then you're like, okay, no big deal. I'll just sell calls against those. Right? And let's say you sell the 27 strike. So you own it at 26, and now you're like, well, I got to sell calls against it. So you own the stock here. You've sold calls at the 27. Let's say it continues to go down. You're going to collect that call premium, but you're losing your ass on how much the price of the stock is going down. But let's say you get really lucky and it comes back up and you sell it out here. Now you have booked a completely ugly, awful loser, because as it went down, you're losing money. You own the shares here, so you do get the capital appreciation right here, but you've already lost on the first trade, probably by more than that amount. And so this is a horrible setup here. The best case outcome is you own the shares, it goes up in value, you sold cover calls against it, and you get to collect the premium week after week, and then it goes up here, the shares are called away. The worst case scenario is putting yourself in the wheel, where you are constantly selling puts, taking losses on those puts to get assigned the shares, then you sell calls against it, and then the calls you're collecting the premium on, then the price goes up, you get the shares assigned away from you, and you booked a loser over and over and over and over and over. It is possibly the worst situation you could put yourself into, because basically you said, let me lose, let me make my losses worse, let me make the losses worse, I can't do anything about it, I have created a vicious cycle, when all you had to do was just buy a long call. Skip all of that. Skip all of that confusion. Skip all of that mess and use the leveraged instrument of a long call that's deep in the money. Skip all of this headache. Skip all of this mess. Skip everything that you have to deal with in order to run the wheel to collect your premium, and just buy deep in the money long calls. That's what I do. It's simple. It works. Will you book losses? Yeah. It's part of the game. Will you book giant winners that you could not ever possibly do on this? Yeah, because that's also part of the game. But you're never going to have big winners on this. Never. Doing the wheel strategy is equivalent to going out on the street, throwing all your money down the drain, asking people for more money that then you can then throw down the drain, and then you go ask people for more money that you can throw down the drain. That is the wheel strategy in a nutshell, right? In fact, Corey mentioned this earlier. I've gotten 234% on his options. He's going to roll it so he can take some profits. That would be an impossibility. Absolutely impossible to do with the wheel strategy. Cannot do that. Crispy had a question. If you sell puts or calls at a given end date, you're stuck with that time date no matter what happens with the option that was sold. Not necessarily, right? If you sell an option that's 21 days to expiration and you decide you don't want the trade anymore at day 19, that's fine. You just get rid of it, right? Can you be assigned at any time? Yes. The likelihood of being assigned at any time is very low if it's out of the money. If that put that you sold goes in the money, you could be assigned any day of the week. You could have sold it on day 21 and then on day 19 or day 18 or day 6, doesn't matter. You can be assigned, right? Somebody can exercise that contract, which puts the shares onto you. Okay. Philip had a question. What do you think about buying 100 stocks and then selling covered calls against them? I sometimes do that with stocks that I think have positive momentum. Yes, I'm a newbie. So like I said, Philip, it's not a bad idea, right? That is the best case outcome here. Buying your stock here, selling your call up here. The best case outcome is if it does go up and through that, but you no longer own the shares. So where Corey had his 200% gains, you're not going to have those, right? You are capping your gains because your risk profile looks like this. You still have unlimited losses, but you have capped your gains. So unfortunately, it's not something that I would do, but you can for sure. And then Nathan had a question. Is there some sort of training or something from Outlier? In fact, yeah, and it's hella free. It's called Outlier University.
Are you ready? Let's go!
Respect is earned. Respect is never given.
That's right. Every Tuesday and Thursday in the afternoon, I teach everything that I know to 9 gentlemen who are live here on the call with me. And you can watch this for free on YouTube. Outlier University has a 100% money back guarantee. If you don't love Outlier University, if you aren't making money with Outlier University, don't worry. We have a 100% money back guarantee. Of course, I'm joking because it's here on YouTube, but I'm teaching you everything that you could possibly know without you even giving me your email. Teaching you everything you could possibly know for not one red cent. There is no paywall. Everything is here on YouTube. Now, 50% of you are going to learn. 50% of you are going to listen without learning anything. It's just going to be consumed passively. 25% of you are going to listen to a video like this and you're like, the wheel strategy, I need to do this. And you're going to go do it and you're going to F things up. And then you're going to say, it's all Chris's fault. The other 25% of you are going to watch, learn, and make generational wealth. You get to choose which one of those percents you get to be in. And Brandon had a great question. What if you keep rolling up the not credit card? What if you keep rolling up the covered call up and out to keep the gains? Let me share my screen. Sorry, I had to turn my screen off for that. All right, looking at this, can you do that? Yeah, for sure. If it's not in the money. If that call that you sold goes in the money, you cannot roll it ever. It is gone. It is out of your account. Like it's physically removed the shares from your account and put it in someone else's. Okay. Additionally, can you roll it and do this week after week? For sure. Right. If you want to collect 14% gains, or I'm sorry, 14 cent gains, not 14%. You wish it was 14%. If you want to collect 14 cent gains week after week after week, you could totally do that. And I forget who said it earlier, but that's pretty much what they're doing on Sound because they're so deep in their losses right there, right? On Sound. Let's go back to that. That he's continuing to roll it over and over and over, trying to collect enough premium to get back to break even. Yes, you can do that. Is it something you want to do? No way. No way. Because honestly, the trade should have been cut ages ago. Is it a way to try and make up some of those losses? For sure. But I would rather be in a position where I don't have to make up those losses and I can move on to a new trade rather than being stuck, my capital tied up in a existing trade that I don't even want anymore. And trying to claw back 14 cents at a time is really difficult. So there you all go. We have learned a ton today. Today was a big, big, big lesson. So I love doing these options deep dives, and I hope you do too. If you have learned anything at all, the way that you can pay me back is just by telling everybody about Outlier and what we're doing here for free. And if I've helped you in any way, save time, make money, and start winning with less risk, you should probably click one of these 2 videos and have a fantastic day. We'll talk soon.